The U.S. military is prepared to strike Iran as early as this weekend, sources are telling CNN.
In this video, I'm going to talk about how a war with Iran could actually affect the U.S. economy and the housing market. Because a Middle Eastern conflict would hurt Americans in a very specific way. Think about energy prices, inflation, and interest rates. You may not think those would all be tied to just Middle Eastern conflicts, but actually there's a very real reason why that's the case. And those three factors alone are enough to impact the housing market and the affordability crisis we currently face in the housing market. So in this video, I'm going to walk you through the real numbers, the mechanics, not just speculation. Then I'll talk about the three most likely scenarios and what those mean for mortgage rates, home prices, and consumer stress. Because if there's one thing the American people don't need more of, that's inflation and consumer stress. So let's talk about what's happening right now. Recent reporting this week has described a serious rise in tensions, including the US preparing for potential operations against Iran and high-stakes nuclear talks. We've also seen reports tied to Iran's military drills and temporary closures of parts of the Strait of Hormuz. And markets reacted immediately. On February 18th, oil prices moved higher as traders priced in geopolitical risk, with the WTI around the mid-60s and Brent near $69. And analysts noted that $5 to $7 per barrel risk premiums are included in current pricing. And as of recording right now, those prices have reached $71. As they continue to price in fear. Now here's the key. The housing market doesn't respond to war. It responds to what war can do to oil and what oil can do to inflation and rates. So let's talk about the point that matters the most here. The Strait of Hormuz is one of the most important energy choke points on the planet. According to the U.S. Energy Information Administration in 2024, oil flow through the strait averaged 20 million barrels per day, which is roughly 20% of global petroleum liquid consumption as of June 2026. And it's not just oil. The EIA also noted that in 2024, about 20% of global LNG trade transited the Strait of Hormuz, largely from Qatar. And so if you think about it, even just plain threats around the strait can move energy markets because traders aren't just pricing in what's happening now. They're pricing in the probability of disruption. And that's why even if the strait isn't shut down right now, you can still have higher oil prices, simply from elevated risk. Now here's where it connects back to you. Energy is one of the fastest ways that inflation gets reignited. People often think that inflation is a single thing, like prices just going up. But energy is special because it's upstream. It hits transportation, shipping, utilities, manufacturing inputs, and consumer behavior. And we have evidence that oil shocks can move inflation quickly. A Federal Reserve analysis modeling oil price shocks found that oil prices increases can noticeably affect headline inflation, adding almost 1 percentage point upon impact in their modeled scenario, as of the analysis in 2024. Now, the exact pass-through depends on magnitude and duration, but the direction is the same. Higher energy prices push inflation up. And when inflation reaccelerates, the next domino is rates. See, this is the part that most people miss. If tensions escalate, mortgage rates can move in either direction, depending on which force dominates. The first force is flight to safety. When investors get scared, they often buy U.S. treasuries, treasury yields drop, and mortgage rates can fall temporarily. The second force is inflation risk. If oil spikes and stays elevated, inflation pressure rises. The Fed stays tighter longer, or markets demand higher yields. Mortgage rates can rise or stay high for longer. So to put it simply, a conflict can cause a short-term dip in rates, but if it drives sustained energy inflation, it can keep rates elevated and make housing affordability worse. Now, let's translate that into what matters for housing: payments, demand, inventory, and prices. There are four main channels here. First, mortgage rates and affordability. Housing is a payment market. If energy inflation pushes rates up, even just a little bit, affordability gets crushed. And we've seen this happen over the last few years. And that's because buyers aren't deciding between a $420,000 home or a $430,000 home. They're deciding between, can I afford this monthly payment, or am I priced out again? And if inflation rises, lenders also price in uncertainty through wider spreads. That can also keep mortgage rates higher even if the Fed doesn't increase the rate. Second, consumer budgets get squeezed. This is something we've been experiencing for the last few years. Everything has been increasing. Groceries, tax bills, most everything that's affecting consumers. So when you have higher gas prices and higher utility costs, those hit consumers fast. And when consumers get hit, they get squeezed. And when they get squeezed, you see weaker consumer sentiment, slower discretionary spending, higher credit reliance, and higher delinquency risk. That matters because housing stress doesn't start with foreclosures. It starts with household cash flow. Third, construction supply can get even more constrained. Energy doesn't just hit consumers. It hits builders and all of the industries around. Higher energy costs increase transportation and logistic costs. And materials that are energy intensive to produce and transport tend to get more expensive when energy is volatile. If new construction slows or costs rise, that keeps supply tight, which can keep prices supported even in a weak demand environment. And this is something we've all experienced over the last few years as well. Even though demand has fallen, supply has fallen with it, so it's kind of equaled out. Fourth, we have regional winners and losers. If oil prices rise significantly, energy producing regions can see some relative benefit in incomes and activity. But energy consuming high cost regions feel the squeeze the hardest. So housing impacts can become even more uneven across the country. Now, rather speaking in generalities, let's map out 3 specific scenarios. These are the scenarios that matter. Scenario A. Tensions rise, but no major disruption. This is the risk premium world. See, oil would stay elevated modestly because traders are pricing in danger, but supply continues. In this scenario, you get market volatility, slightly higher energy costs, but no sustained inflation wave. The housing impact from this scenario would be rates may not change much, buyers remain constrained mostly by the existing affordability issues, and housing stays where it is right now, not crashing and not rising. This scenario is consistent with what we're already seeing. Oil reacting and analysts describing a risk premium rather than a base case supply shock. Scenario B, short disruption with limited escalation. In this scenario, oil would spike for weeks, then cool down shortly after. Inflation would tick up, consumer stress would rise, but it's not a multi-month surge. It would happen very quickly and come down quickly. Now, in this scenario, the housing impact could be this. Mortgage rates could go around, go up, go down, be very unpredictable. Buyer demand could soften temporarily, and some local markets with weak demand could see price cuts. Then nationally, supply constraints can still prevent a major drop. This is the more volatility, but not necessarily a crash scenario. Scenario C. There could be major disruption through the Strait of Hormuz. This is the high impact scenario because Hormuz is massive. Again, 20 million barrels a day, about 20% of global liquids. If flows are disrupted meaningfully, energy prices can surge sharply and inflation can re-accelerate. And in this scenario, the housing impact would be wild. We'd have inflation rising, the Fed would stay tight on rates longer or increase rates again, mortgage rates stay high, consumer budgets get squeezed harder because of the rising costs, delinquencies would rise, and housing demand would further weaken. But there is a twist in this scenario. Even in this scenario, it doesn't automatically mean prices collapse nationally, because price declines require one of 2 things: a huge demand shock and a supply surge. Foreclosures can create supply, but only if they move aggressively, not just trickle in. So the real risk is not war equals housing crash. The real risk is war creates energy shock, which creates inflation, which creates higher for longer rates, which creates affordability breaks further, which also adds to consumer stress. And that creates the conditions for wider housing weakness over time, especially in already stretched markets. So if we zoom out, this is where the geopolitical risk matters in 2026. See, housing is already trying to stabilize after a rate shock, affordability compression, and consumer stress. Foreclosure filings have already begun rising year over year for months. And in January 2026, there were more than 40,000 foreclosure filings, which were an increase from the previous January of over 32%. See, that doesn't mean crisis, but it does mean there's less margin for error. So if you add energy inflation shock on top of an already strained affordability environment, you can amplify stress even further. This is how macro risk becomes real life. So if you want to track this like an analyst, not like a headline reader, watch these 5 indicators. 1. The Brent and WTI oil trends. Not just one-day spikes, but sustained movement. 2nd, gas prices. We all look at gas prices and we see if they go up or down, and we correlate that back to how the economy is doing, because this hits the consumers first and fastest. The 3rd thing to watch is the 10-year Treasury yields. This influences mortgage rates, especially during risk events. The 4th thing is inflation expectations. If expectations rise, rates will stay higher longer. And finally, mortgage rate direction. If interest rates stay sticky while energy rises, housing affordability will deteriorate. So what impact could a US-Iran war have on the economy and housing? It comes down to this. If escalation stays contained, the housing market likely stays in the similar shape as it is now, which means tight supply, strained affordability, and frozen transaction volume. But if escalation triggers a major energy shock, especially involving the Strait, then the risk is not an instant crash. The risk is higher inflation, higher for longer rate, which squeezes consumers, raises stress, and makes the housing market more fragile heading deeper into 2026. And that's the real takeaway. Housing doesn't need a repeat of 2008 to struggle. It just simply needs affordability to get worse. And so those are the things to watch out for if we go to war in the Middle East. Hope that was helpful. Thanks for watching.